Welcome back to another episode of Deep Thoughts on Securitized Markets. Instead of my normal co-host, Jim Egan, who is hiding because he does not want to hear me talk about how well the Patriots played against the Chargers last week, I am joined by my colleague in agency mortgage research, Janie Shuey. Janie, welcome.
Thanks for having me on, Jay. And I decided to match the memo and wear a cardigan.
Look, if I know much about 2026, we're going to get a lot of social media messages and cardigans are back in style. So thank you.
Good way to start the year. Speaking of, we also recently shifted from long basis to neutral on Monday, saying that QE is sort of in the price after the GSE buying program was announced on Thursday afternoon. Jay, do you mind explaining your thoughts a little bit on that move?
Sure. Look, when we wrote the note in response to the announcement of the program, we said that this program looks contextually similar in size to the Fed balance sheet runoff, which is round numbers, $200 billion a year. Fed balance sheet runoff is worth 15 basis points historically. On Friday, current coupon basis tightened by 14.5 basis points. So that's pretty close. And we're like, all right. So from there, we said spreads have tightened to basically levels that we haven't seen unless the Fed was adding in material size. This program looks a little bit like the Fed adding, but it's not the same. So current coupon OAS near zero. Let's move to neutral.
Yeah, and some of those differences should limit the upside in valuations there, right?
Yeah. Look, these are both likely some form of non-economic buying of mortgages and will also likely cause a portfolio balance channel effect on other risk assets. So that's kind of why we think it looks like QE. But there are some real differences. The Fed, when they buy assets, they are creating reserves. And so that also flows through, according to our banking analysts, into deposits, which leads to bank demand for security. So there's a multiplier effect. That's one thing. Within mortgages, the Fed's programs have historically been larger and at a faster pace. The Fed buys the TBA and they take delivery. So they're taking out the most negatively convex bonds from the market. And also, the Fed programs, they're generally a little bit more transparent about what they're doing. We know the size, we know the pace. This program, we have a lot of questions, don't we?
Yeah, certainly beginning a lot of questions on our side. Obviously, right now, the only public information we have is that they're going to be buying $200 billion of mortgage-backed securities. We don't even know if that includes what they've already been buying, based on their monthly volume summaries from 2025. But, we don't know how they're funding these purchases. We don't know if they're hedged. We don't know what coupons they're buying, what types of mortgage-backed securities they're buying. All of those matter to the impact to mortgage spreads, and we just don't have that information right now.
Right. And so another reason why we went neutral is the headline $200 billion. It's similar to the Fed balance sheet runoff. And Secretary Treasury Bezos actually alluded to this in an interview with Reuters that they're sort of designed to offset each other. However, it's not, in our view, a $200 billion shock to the market. As you mentioned, the monthly volume summaries that we get from the GSE started to show a pickup already towards the end of last year. They went from buying about $5 to $6 billion a month to $15 to $16 billion a month. Now, we don't think it's likely that the GSEs were going to buy $15 to $16 billion a month before this program was announced, but if the market knew about that, they were probably expecting maybe $100-ish billion of GSE demand this year. So this is more like an incremental $100 billion on top of the $100 billion expected. That's another reason why we moved to neutral is ending Fed balance sheet runoff is $200 billion per year. That's worth 15 basis points. This is as announced, $100 billion increase one time.
Yeah. So obviously that additional demand is more than priced in. And we have a lot of unknowns. Things have retraced a little bit over the last day or so, but why not go short?
Good question. Well, first off, we don't know a lot of things about this program, as you said. And so one of the things that we don't know is the pace. And so there's a big difference between buying $200 billion over 2 years and buying $200 billion over 3 months. There's certainly a possibility that the pace is faster than we are expecting. It could get bigger. We also, when we were long mortgages, we weren't long mortgages because we thought the GSEs were going to go buy hundreds of billion. We were long mortgages because we thought banks were going to buy as they got resolution around the Basel Endgame. This increases our confidence that we're going to get resolution around the Basel Endgame earlier, and probably increases the likelihood that we could get positive news around, for instance, the risk weights on conventional mortgages, which would likely cause the basis to tighten. Also, it's possible that maybe that under a new administration, that the Fed might change their views on the composition of the balance sheet. So that would be incremental demand for mortgages as well. Lastly, on the technical side, rolls are trading pretty special here, which makes shorting the basis expensive. So valuations are tight. They're tight for a reason. We're neutral here.
Yeah, makes a lot of sense. A lot of events on the table right now. Is there any space within mortgages that you think maybe looks interesting for investors right now?
Yeah, we're still recommending long agency CMBS, and higher coupons have really lagged the move as investors have been worried about the prepay response, as maybe the GSEs will focus their demand a little bit lower and there won't be support for the higher coupons, and the media effect will cause prepays to pick up. Also, maybe there's a G fee cut. All of those are bad for higher coupons, but you can probably get some protection in that by owning higher coupon specs. So we think if you want to own mortgages here, you want to be neutral, where should you be positioned? Well, maybe you want to own some of the TBAs that are rolling special, or these higher coupon specs and agency CMBS.
I mean, speaking of prepay risk, it certainly seems like housing affordability is a focus of the administration, and it sounds like we're going to hear more about it in the next few weeks at Davos.
That seems to be the headlines that are coming out from this administration. I'm sure we're going to get more headlines, but Janie, thank you for joining. I have to say, it's a little painful for me to sit in front of this picture of somebody wearing a New York Yankees statue sweatshirt thing, but you look great under that Boston sweater.
Appreciate it. Thank you, Jay.
Okay. And thank you all for listening. We'll see you next week with a hopefully more rested and tan coming back from CREFC, Mr. Egan.